From the heart of the nation's capital, this is the Evening News. Breaking news starts now.
3 weeks ago, in a routine regulatory filing released on a quiet Friday afternoon, a number surfaced that should have detonated across every financial newsroom in America. It didn't. Instead, it slipped by almost unnoticed. According to disclosures cited in a widely circulated January 2026 financial analysis, Goldman Sachs had significantly reduced its US government securities holdings year over year, with the broader claim that major institutions collectively shed as much as $847 billion in US Treasury exposure over the past 18 months. If accurate in scope and interpretation, that is not a portfolio tweak. That is a geopolitical signal. Let's be precise about what is confirmed and what remains debated. Public regulatory filings show that large US banks have adjusted their securities portfolios materially between 2024 and late 2025, as higher interest rates reshaped balance sheet strategy. The Federal Reserve's benchmark rate, which peaked around 5.25 to 50% in July 2023, remained elevated through much of 2024 before easing into the 4.25 to 4.50% range by early 2026. During that tightening cycle, bond prices fell sharply as yields rose, producing large unrealized losses across the banking system. That mechanism is not speculative, it is mechanical. When rates rise, existing bonds lose value. This dynamic was at the heart of the collapse of Silicon Valley Bank in March 2023, when rapid depositor withdrawals forced the bank to realize losses on long-dated treasuries purchased during the near-zero rate era. Now layer on the sovereign dimension. As of fiscal year 2024, the US national debt surpassed $36 trillion. The Congressional Budget Office projected that federal net interest outlays would exceed $1 trillion annually within the decade, with 2024 already approaching record levels near $879 billion. By early 2026, federal interest costs were on track to cross the $1 trillion threshold. That is not abstract. It means the United States is spending more on servicing past debt than on many major domestic programs. And every additional percentage point in average borrowing cost compounds that pressure. Here is where the geopolitical layer becomes unavoidable. Roughly $7 to $8 trillion of US Treasury securities are held by foreign investors. Japan remains the largest foreign holder, with holdings fluctuating around $1 trillion. China, which once held over $1.3 trillion in 2013, has reduced its position to roughly $700 to $60 billion by 2025, according to US Treasury data. India trimmed holdings by approximately 21% between late 2024 and late 2025, according to reported financial data. Meanwhile, the Dutch pension giant ABP confirmed in January 2026 that it had reduced its exposure to US Treasuries during the previous year. These are not marginal players. These are pillars of the global capital structure. Officially, these moves are framed as diversification, duration management, or regulatory optimization under Basel III capital rules. That explanation is plausible. Banks adjust liquidity buffers. Pension funds rebalance. Central banks manage currency risk. But when multiple actors simultaneously reduce exposure to what has been called the risk-free asset, the optics shift. Because US Treasuries are not merely financial instruments, they are the collateral backbone of the global monetary system. They underpin repo markets, derivatives pricing, sovereign reserves, and dollar liquidity worldwide. At the same time, the Federal Reserve has been shrinking its own balance sheet. After expanding from roughly $4 trillion pre-pandemic to nearly $9 trillion in 2022 through quantitative easing, the Fed began quantitative tightening in mid-2022. By early 2026, the balance sheet had declined to approximately $7.1 trillion. That means the private market has had to absorb nearly $2 trillion in additional Treasury supply during a period of elevated deficits. In fiscal year 2025, the federal deficit again approached $2 trillion. Supply is rising, official buyers are less aggressive, and domestic banks are not increasing duration risk at previous levels. This is not yet collapse. The Treasury market remains the deepest and most liquid bond market in the world. The US dollar remains the dominant reserve currency, accounting for the majority of global foreign exchange reserves and trade invoicing. There is no immediate substitute of comparable scale. The euro carries structural fragmentation risk. The yuan remains constrained by capital controls. Gold cannot settle global trade at scale. Those realities matter, but systems do not unravel gradually in visible slow motion. They hold until they don't. In 1979, when Paul Volcker raised rates to nearly 20% to crush inflation, US debt to GDP was around 30%. Today it is over 120%. The policy space is narrower. Raise rates too high and interest costs explode. Keep rates too low and inflation expectations re-anchor upward. That tension is not ideological, it is arithmetic. So what does it mean if major financial institutions are shortening duration, boosting liquidity, and trimming long-term sovereign exposure? It means they are positioning for volatility. It means they are not assuming a smooth glide path back to 2% inflation. It means they are preparing for scenarios in which confidence becomes the decisive variable. And confidence in sovereign debt markets is binary. It exists or it evaporates. What happens if the next shock is not a mid-sized regional bank, but a sovereign liquidity event amplified by geopolitics, energy shocks, or escalating sanctions regimes? What happens if Treasury yields spike not because of growth optimism, but because buyers demand a higher risk premium for fiscal uncertainty? That is where this story stops being about bond math and starts becoming about global power. Because when the anchor asset of the international system wobbles, the consequences are never purely financial. And the real question now is not whether something shifted quietly in late 2025, it's who moved first and why. What comes next is where the geopolitical fault lines truly begin to crack. If the first tremor was financial, the second is strategic. Because US Treasuries are not just balance sheet assets, they are geopolitical leverage. For more than half a century, the United States has enjoyed what former French finance minister Valéry Giscard d'Estaing famously called the exorbitant privilege of issuing the world's reserve currency. That privilege allows Washington to borrow in its own currency at scale, finance deficits others could never sustain, and fund military, industrial, and technological dominance without facing the same immediate market discipline imposed on emerging economies. The dollar's dominance is reinforced by the Treasury market's depth. Global trade is settled in dollars. Oil is priced in dollars. Central banks hold dollars, and those dollars are recycled into treasuries. But that cycle is no longer politically neutral. Since 2022, geopolitics has accelerated financial fragmentation. The freezing of Russia's foreign exchange reserves after the invasion of Ukraine signaled to sovereign states that reserve assets could become instruments of sanction. The message was clear: access to the dollar system is conditional. For US allies, that reinforced alignment. For strategic competitors and non-aligned powers, it triggered recalculation. China has been gradually reducing its treasury exposure for over a decade, declining from more than $1.3 trillion in 2013 to roughly $760 billion by 2025. This is not a panic sell-off, it is a structural repositioning. Beijing has simultaneously increased gold reserves and promoted settlement mechanisms that bypass dollar clearing channels. The BRICS bloc, Brazil, Russia, India, China, South Africa, has intensified discussions around alternative payment systems and cross-border trade in local currencies. While none of these initiatives yet rival the scale of the dollar system, the direction is unmistakable. Diversification away from single-point dependency. China has been gradually reducing its Treasury exposure for over a decade, declining from more than $1.3 trillion in 2013 to roughly $760 billion by 2025. This is not a panic sell-off, it is a structural repositioning. Beijing has simultaneously increased gold reserves and promoted settlement mechanisms that bypass dollar clearing channels. The BRICS bloc, Brazil, Russia, India, China, South Africa, has intensified discussions around alternative payment systems and cross-border trade in local currencies. While none of these initiatives yet rival the scale of the dollar system, the direction is unmistakable. Diversification away from single-point dependency. Japan, still the largest foreign holder of treasuries at roughly $1 trillion, faces its own dilemma. The Bank of Japan has spent years managing yield curve control domestically. Rising US yields create currency volatility, pressuring the yen. To defend exchange stability, Tokyo has at times sold treasuries to support its currency. That is not a political protest, it is a monetary necessity. Yet the effect is the same. Marginal demand for US debt becomes less automatic. In Europe, the recalibration is quieter but real. In January 2026, Dutch pension giant ABP confirmed it had reduced US Treasury holdings over the prior year. Pension funds do not operate on ideology. They operate on risk-adjusted return. When duration risk rises and fiscal trajectories look unstable, reallocation follows. Now consider the arithmetic. The US federal deficit in fiscal year 2025 approached $2 trillion. The national debt sits above $36 trillion. Net interest payments are on track to exceed $1 trillion annually. At the same time, the Federal Reserve has been shrinking its balance sheet from its pandemic peak, near $9 trillion, down to roughly $7.1 trillion as of early 2026. That means the marginal buyer of last resort is stepping back, just as issuance remains historically high. In this environment, even subtle shifts in foreign participation matter. If geopolitical rivals reduce Treasury exposure, it is not an act of aggression, it is risk management. But collectively, it shifts pricing power. Higher yields are not just a reflection of inflation expectations, they become a referendum on fiscal credibility. And when yields rise, borrowing costs for Washington rise with them, amplifying deficits and reinforcing the debt dynamic. This is where financial plumbing meets strategic doctrine. The United States relies on deep treasury markets to finance not only domestic spending, but also its global security architecture. Carrier strike groups, forward deployments, technological subsidies, industrial policy initiatives, all of it rests on the ability to borrow at scale and at relatively low cost. If that cost rises persistently, fiscal trade-offs become unavoidable. At the same time, US policymakers face a constrained monetary choice set. In 1979, when Paul Volcker raised rates to nearly 20% to break inflation, federal debt to GDP was roughly 30%. Today it exceeds 120%. Raising rates aggressively to suppress inflation risks detonating interest costs. Keeping rates too low risks embedding inflation expectations. The margin for error is thinner. Global markets are watching that margin. The Treasury market has already shown flashes of instability in recent years, including episodes in which yields spiked sharply on supply concerns rather than growth optimism. Liquidity studies by the New York Fed in 2025 examined strains in market functioning, not collapse, but friction. The fact that such studies are necessary underscores that treasuries are no longer behaving as a purely passive safe haven. None of this means the dollar system is ending tomorrow. It does mean the world is hedging, and hedging is a political act. when sovereign wealth funds buy more gold, when BRICS nations explore cross-border alternatives, when European pension funds trim exposure, and when Wall Street institutions boost liquidity and reduce duration risk, it signals a recalibration of trust. Trust is the currency beneath currency. The United States still commands unmatched military reach, technological innovation, and financial depth. But financial dominance depends on perception as much as policy. If global actors begin to price in geopolitical fragmentation as a baseline rather than an exception, Treasury demand elasticity changes. That shift does not happen in headlines. It happens in quarterly filings, in central bank reserve tables, in auction bid-to-cover ratios, and in yield curves that steepen for reasons not fully explained by growth. The critical insight is this: Treasuries are not merely instruments of US fiscal policy. They are instruments of global alignment. Owning them has historically signaled participation in the American-led order. Reducing exposure signals strategic optionality. And when optionality becomes the dominant strategy among major powers, the architecture of the post-World War II financial system quietly enters a new phase. The next question is not whether diversification will continue. It is how Washington responds if it does, because the next move may not come from Wall Street, it may come from Capitol Hill, or from a foreign capital calculating leverage in a world where debt, diplomacy, and deterrence are now inseparable. Thank you for listening. Before you step away, share your perspective in the comments. If you found this breakdown valuable, hit like and subscribe, then turn on notifications so you don't miss the most critical political developments as they break day after day. See you next time.